Hey guys, today I wanted to go over my top financial dividend stock to buy now, and that is T. Rowe Price. And guys, the reason that I am so interested in this financial powerhouse is because if you look at it right now, I have 100 shares. I have about $11,000, round up a little bit, $11,000 of market value. Average cost is $122 per share. 22% of my portfolio is in this stock already. Today we're down $109, but total we're down over $1,300 or almost 11% on this position. Do have a dividend coming in on the 30th of $122 a share. But guys, let's take a look and see exactly why I'm so excited to buy this stock. So just on a price basis, of course, I don't pay attention a lot to price, but the thing is, it is well below my average cost right now. So right now I'm sitting at about, say, 110 bucks a share, right? And my average cost is 121. So I can cost down average almost 12, well, about $12 here, 12 or 13 bucks here, and get a higher yield. So right now it's yielding, according to Robinhood, it's like 4.4%. But when I bought it, it was only yielding about 3.5%. So I can get, almost 0.2% more 0.2% more out of this yield, which means I pay less and I get more out of it. And guys, the reason that I am so bullish on T. Rowe Price is because it has a solid history of earnings growth. So the thing is, they perform based on market fluctuation. So if the market's doing really well, then T. Rowe Price stock is probably going to do well because they have a lot of U.S. based mutual funds as their big products that they sell. Of course, they've diversified. They have tech, they have utilities. They of course have outreached into foreign markets and stuff like that. But the main product is US ETFs. It's mutual funds based on US markets. So when the US market doesn't do so hot, T. Rowe Price stock drops. So, and of course, if you guys have been living under a rock, then you obviously know that there has been a huge banking scandal, which of course has poured into the financial sector. Some have felt it. Banks have been extremely washed lately, but we're now seeing it come into some of the investment bureaus as well, and insurance as well has been affected. So, like stocks like Aflac or Allstate or Prudential or Chubb, and of course you have stocks like T. Rowe Price, Fidelity, and like anything that works around payment processing has been affected as well. Visa's actually held up pretty well, but T. Rowe Price is just slammed here. And so the reason that I love it so much is because one, I'm a dividend growth investor. And so they have risen their dividend for their, of course, dividend aristocrat status, which is one of the things that I look for. But they have had a really good compound annual growth rate for their dividend. So this past year, I think it was like 2.2%. But given the fact that the market was kind of on a downtrend, that made sense. They're not going to reward shareholders as much if their business is kind of seeing a downturn. So that makes sense. But prior to this past year, it's been double-digit dividend increases for almost a decade. So they have done a very good job of balancing their payout ratio, which means that so let's say their payout ratio, I think it's like, say it's 50%, right? That means that they give the shareholders 50% and they have 50% of free cash to invest back into the business. That's really healthy. So a lot of times what companies will do is it's kind of a mixed bag. So sometimes you can either get a really low payout ratio, like something like a Microsoft or an Apple, where most like 90% of their earnings or 70+% of their earnings go back into the business, which makes sense because they're still kind of growth companies, but they do add a small dividend onto it. And in some of those tech companies, like I think Microsoft has grown the dividend for 14 or 15 years now, I believe, or 15 plus years. So they have a smaller dividend, but it grows at a decent rate. But T. Rowe Price has had a very consistent dividend with double-digit dividend increases. So this is like the creme de la creme of dividend-paying stocks. Because what you want is you want a very healthy balance between the dividend that they're paying and the ability for them to increase that dividend. So I went heavy into T. Rowe Price because I felt like at 122 or around 122, it was a really good it was a good purchase price because the 52-week high was 160 bucks, right? So I had like almost a $40 upside on this position. Now we have like a 52 or $54 upside on this around, right? So, well, we have like a 40, 44 or something like that. So we have now even more. So it went from 30 to $40 plus, right? So now it's an even better deal for me. And if you're getting in, it's a great, you're getting a great company. They've had really consistent, regardless of fluctuations of the market, they've had a really good history of dividend growth. They've had a really good history of rewarding shareholders consecutively with dividend growth. And they understand how to manage their money really well. And that's the big issue. Some of these companies like AT&T just slashed their dividend last year because they did not have the cash flow to keep, well, they did, but they didn't want to reward shareholders in that way. So what happened was they lost a third of their profitability with that Time Warner spinoff approximately, and then they cut the dividend by 50%. And honestly, shareholders were ticked. So sometimes, and you get this with yield traps as well, where like if say a stock's paying a 14% dividend and people are like, oh, that's great. Well, then you look at their balance sheet and their payout ratio is like 115%. They can't pay out more than they make, so it's not sustainable. They cut their dividend, and everybody gets out of the stock. So when you're a dividend investor, you want to find those companies that have that track record, but focus on the future of that company. So yes, the last dividend increase may have been small for T. Rowe Price, but given the economic environment that they were in at that point, it made sense, right? But they're not over leveraged. They're actually negative net debt, so they're completely clean. They can pay off all their debt if they even have any. So they're a debt-free company. They're very good with their balance sheet is phenomenal. They have plenty of assets to deal with any liabilities that they need to acquire, as well as management knows how to balance the profitability of the business with rewarding shareholders because they're not bleeding out cash flow to pay out this dividend. They're very comfortable, and I feel like they can um, bump this dividend up or raise this dividend for a few decades before they have an issue. I mean, profitability is not that fluctuating, isn't fluctuating that bad, because a lot of their profit is fee based. So it's relative. It's kind of like think of it like an insurance claim, right? Or an insurance policy. You pay every month. That's kind of what these people do is they get fees for managing, quote unquote, managing the funds, and then they can reuse that. It's like float. So then they reinvest that into a different portfolio or make a new mutual fund or whatever. It's kind of like a cog machine. Like it just keeps rolling as people. So as long as they have customers and they have people in their funds, they're going to be fine. Which there, of course, is some issue. Like, of course, I use Robinhood. I do my own I do my own self-directed investing, and a lot of people do. But there are a lot of people that still go for that managed mutual fund, that don't want to have a hands-on approach. They want it to just be set it, forget it, be done with it, let somebody else manage their money. I'm not that way, but honestly, I did look into T. Rowe Price for an investment, for just to put my money into a company that I understood, and I didn't meet the minimum requirements. It's like I think it was like 150,000 or something was the minimum. So I'll get there, but just given the overall market sentiment on financials right now, my average price is super low, and the business is great. I mean, of course, it's going to fluctuate, given any business will, but I think that they've had a stellar track record. They've really put in the forefront that they want to respect their shareholders, be true to their word, keep their streak going, but keep focused on the profitability of the business. So they are focused on business growth, but they're also rewarding shareholders for holding their stock. And that's the whole point of a dividend investment, right? Is if T. Rowe Price as a business can't pump out better cash flows, or at least consistent cash flows, they aren't going to be able to grow their dividend, and then there's no reason in owning them. So the real magic with dividend stocks is the compound factor. So like if you bought T. Rowe Price, say 30 years ago, when the dividend streak started, maybe you were only getting like 25 to 40 cents. and now you're getting $1.22. And every single year, say you had 100 shares like 30 years ago, you got 40 cents, then you got 44 cents, you got 47 cents. It's not a lot in the moment, but as you hold on to these companies, like Warren Buffett has done for Coca-Cola or Warren Buffett has done for American Express, these are like 10 to 20 baggers for him or 100 baggers for him because he's held them for so long. He found a quality company at a reduced price, which I believe T. Rowe Price is right now. He held a company just that had the same type of statistics, had the same type of management and integrity, and it's worked wonders for him. I think his best investment right now is American Express. I could be wrong, but I do know that he's held that for a long time. And so I think at these prices, of course, T. Rowe Price is a huge bargain. And given the quality, given the management, and how well they've run the company, as well as how well they've managed their free cash and have negative net debt, I'm willing to take a couple years of maybe smaller dividend increases. I'll just keep buying shares. Hold it for a couple decades, let it compound, and then reap the benefits. I mean, the long-term goal for this portfolio is to retire off of this. And with a 50 to 50% or below payout ratio, I have no issue holding this stock. So for me personally, guys, T. Rowe Price right now, I think it's better than any of the big banks because they have not had that inconsistency with profitability. That's really why I don't look into banks, and I feel like T. Rowe Price or even an insurance company like an Aflac or a Prudential or an Allstate or a Chubb is better than the banks just because they don't have as much, like they haven't had as much bad press. You know, people weren't worried about insurance companies or investment banks or investment arms like T. Rowe Price with as much when the 2008 financial crisis hit. So that's why, yes, I think banks are a better deal right now, but in my eyes, I can't find a better stock in the financial sector than T. Rowe Price for me right now. But guys, let me know what you think down in the comments below. What do you think is the best deal? You know, maybe it's Bank of America. Maybe you're big on JP Morgan Chase. You know, a lot of people are really big on banks. It's just not in my circle of competence, but I wanted to mention it because they're in the same realm, right? Like they're all affected by this differently. And I think T. Rowe Price is just such a glaring deal right now. So if I had the cash, I'd double up my share count right now if I had it. So if I had $10,000 or $11,000 just chilling in the bank, I'd double up my share count. With that being said, guys, thank you so much for watching, and I'll see you guys in the next upload. Remember to hit the subscribe button on my channel. That Dividend Guy means so much, guys. These videos keep me so pumped up and so motivated to keep going and keep adding and keep reinvesting dividends, so it really does help me out. Thank you guys so much for watching, and I'll see you guys in the next video. Take care, guys.